We've seen this movie before. Tariffs. Retaliation. Headlines about economic warfare. But this time, it's different. Welcome to what many are calling Trade War 2.0, the renewed economic standoff between the United States and China. Only now, the stakes are higher, the rhetoric is louder, and the market impact? Already showing up in real time. In this video, we're going to break down what's actually happening, how it's shaping the global investing landscape, and most importantly, what it means for your portfolio. Whether you're holding US tech stocks, Chinese equities, industrials, or ETFs, this affects you. And the implications might be bigger than most realize. Let's get into it. What's actually happening? Over the past few weeks, the US, led by Donald Trump's Liberation Day trade agenda, has moved aggressively to reinstate and expand tariffs on key Chinese imports. This isn't just a continuation of the 2018 to 2019 trade tensions. This is a full-scale relaunch with even broader ambitions. New tariffs target electric vehicles, EVs, solar panels and renewable tech, steel and aluminum, advanced semiconductors and AI hardware. The message is clear: reduce dependency on China, boost domestic manufacturing, and regain control over strategic industries. China isn't standing still. Analysts expect retaliation in the form of tariffs on US agricultural exports, soybeans, corn, wheat, regulatory pressure on US companies operating in China, tech-specific bans or sourcing shifts toward domestic suppliers. What makes this different from 2018? There's now a bipartisan consensus around reducing Chinese influence in US supply chains. And unlike the last round, this isn't just about trade, it's about national security, AI dominance, and geopolitical positioning. Who gets hit? Let's be clear, tariffs are effectively taxes, and they impact company margins directly. Companies with deep China exposure or dependence on Chinese supply chains will feel the brunt first. Tesla, TSLA already seeing speculation about retaliatory tariffs on EVs. Tesla's Shanghai Gigafactory produces a significant portion of its global output. Apple, AAPL heavily reliant on Foxconn and Chinese suppliers. Even the suggestion of delays or friction can cause share price volatility. NVDA, its H20 AI chips destined for China now face export license issues. The recent $5.5 billion write-down was directly tied to this. Caterpillar, CAT with major sales tied to global infrastructure, demand shifts in Asia could weigh heavily on projections. And let's not forget the Chinese companies listed on US exchanges. Alibaba, Baba, JD.com, JD, NIO. These companies are dealing with both local regulatory tightening and geopolitical devaluation risk. US investors may view them as too risky despite fundamental strength. Even multinational conglomerates like Boeing, BA, and Qualcomm, QCOM, could find themselves caught in the crossfire, not just through lost contracts but rising political scrutiny. The result? Heightened volatility, especially for companies sitting at the intersection of global tech and trade. Are there winners? Yes, even in trade wars, there are strategic beneficiaries. Expect capital rotation into domestic industrials, companies like Deere, DE, Nucor, NUE, and Cleveland-Cliffs, CLF, could benefit from infrastructure projects and reshoring initiatives. Defense contractors, with military and economic tensions increasing, firms like Lockheed Martin, LMT, Raytheon, RTX, and Northrop Grumman, NOC, are often viewed as safe havens. Logistics and rail, think Union Pacific, UNP, and CSX Corp, CSX, key players in internal goods movement. Alternative EM exposure, ETFs focused on India, INDA, Vietnam, VNM, and Southeast Asia, ASEA, may see increased interest as capital diversifies away from China. And don't overlook semiconductor fabrication companies based in the US or Taiwan, such as Intel, INTC, or Taiwan Semiconductor, TSM, which may receive increased funding and government support as Western nations build redundancy in chip supply. This is about supply chain realignment, and every disruption creates opportunity. What this means for investors. Here's what to watch for. Volatility will increase, particularly in tech and consumer electronics, where margins are thin and dependency on China is high. Policy risk is back in the driver's seat. For a few years, markets moved based on earnings and rates. Now, politics and trade policy are again major catalysts. Sector rotation could accelerate. If these tariffs stick, expect investors to shift toward value sectors, especially US-focused industrials, manufacturing, energy, and defense. Currency and commodity fluctuations. The dollar-yuan exchange rate, rare earth metals, copper, and oil could all respond to escalations. Watch resource-based ETFs and FX proxies. Discounted entry points may emerge. When macro fear takes over, even quality companies get punished. For long-term investors, this may be an ideal window to build positions in resilient businesses that get dragged down by sentiment. Final take. Trade wars are messy, prolonged, and politically charged. They often become narrative battles more than purely economic decisions. But for stock market investors, the key is to understand where money is flowing before the crowd reacts. We are now entering a phase where geopolitical alignment matters almost as much as revenue growth. Companies that adapt to a post-China world will survive, maybe even thrive. Others, more reliant on legacy supply chains, may struggle. So what do? Stay informed. Stay nimble. Stay long on companies building real resilience. Let me know in the comments, are you positioning for volatility or buying the dips? What sectors are on your radar? And if you want sharp, no-fluff commentary on the shifts shaping our financial future, hit subscribe. Catch you in the next one.